Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been helping people take delivery of precious metals and find storage options for decades. They've also helped thousands of investors with their precious metals IRAs. Call ICA today for your free portfolio review at 800-525-9556 or download your free report online by clicking the link in the video description to learn how you can double your gold and silver ounces even within an IRA.
Welcome back to Golden Roll Radio. We're right here at the end of quarter two and start of quarter three. And would you believe it? Gold looks like it is the lowest it's been for a while, maybe since this last end of the quarter one. I wonder if something's going on there. So at the end of June, here we are. June's a weak month for gold. We've seen weakness in the gold price. Looks like it's showing a little strength here on Wednesday. Silver popped back above 26. Gold's right around 1770. And I personally wouldn't be shocked to see this be a little bottom before here we come into July and start to see some seasonal strength. So let's jump into the charts.
Yeah, thanks, Robert. We're definitely looking at a slightly lower price in gold since where we were at in June. We're kind of back to the beginning of May pricing here in the mid to high 1700s, 1770. Gold has now taken two little short-term steps down, a little bit of a bounce today, end of quarter, jump back up. But following our discussion last week involving assumed long-term interest rates, as well as options expiring last Friday, now we're at the end of a quarter. Not surprising to see gold inching down. I actually would like to see gold take one more little drop down because we are seeing some RSI divergence downwards. We're looking at RSI bottoming out with some decline in the price of gold. We're seeing the opposite in some other markets I'll point out here later today. I'd like to see gold come down to about 1730. Nice little floor there. And then obviously the old 618 fib we talked about earlier this year back in March is another potential. So with that being said, yes, we're continuing to see gold put in higher lows in the long term. You know, you look back at a year ago, gold in the 1500s. We came back earlier this year, gold bottoming in just below 1700. And if you're right and I'm wrong, if we are putting a little short-term bottom here in gold and continuing to step back up, then of course you're looking at gold over the last couple of years continuing to put in higher lows. Now, regardless of what gold does in the short term, as far as I can tell, gold's still up $500-600 over the last few years, and that's not surprising at all. So gold continues its long-term bullish trend, and you're going to have these pullbacks from time to time that provide opportunity, not just in the dollar price of gold, but also in the relative price of gold compared to other metals like silver.
You know, another interesting way to look at the gold market right now is Elliott wave theory. You know, they follow sort of an A climb, B decline, larger C climb followed by a much larger D decline. If we go back to and you just look at it from that type of an analysis, we've had a little A climb here and you expect there to be a B decline. And that's what we're sort of into. And if that ends up being as short as the last B decline, what took us to record highs last August was that C wave climb in the gold price. For those chartists that follow that type of a theory, let's hope that this is a short-lived B decline and that Miles' second point ends up coming out and becoming the reality, and we see those previous highs tested again as we really top out in a strong C market climb.
Sure, and one of my big arguments has always been, you know, a trend continues until proven otherwise. And I like to break things into time frames, which Tori, you and I have talked about a fair bit, long-term, medium-term, short-term. We're clearly in a long-term bull market in gold. It's significant, and like you said, we're going to have these B and these D wave corrections back down. But in the medium term, you know, over the last 6-9 months, gold has obviously been down. You know, we peaked out just under 2,100. We've been as low as 1,690. And each stair step down has been a stair step down. We're putting in lower lows. We're putting in lower highs. And even with the big increase we had since the March bottom, going from 1,690 all the way up to about 1,950, that still failed to put in a higher high than what we had back in January of 2021. So until proven otherwise, the long-term trend remains very strongly bullish. The medium-term trend remains slightly bearish. And this is where you get into your Elliott wave theory of this wave theory of ups and downs, aggressive ups and then aggressive downs in between those.
The other thing you have going, Robert, maybe you can speak more to this, is just closing at the quarter. You bring up the point often, December tends to be the low for the year. Well, so does June. And each of those, you've got end of year, you've got mid-year, but that quarterly profit taking, you see the precious metals and those alternative assets hit at the end of each quarter where you can sort of switch positions, take profits. And it's not surprising to me to see so far December, March, and June both put in lows after rallies and profit taking.
Yeah, since the last end of the quarter, into March, beginning of April, I'd have to say that this rally up above 1900 that we saw from end of March through May, it was a nice rally. It could have stopped a lot shorter in the 1800s, but it didn't. It blew from 1680 up to 1900. That is a significant rally in a short amount of time after a nice double bottom with gold. So this pullback here into the 1700s, we were predicting it was going to happen. We like for it to happen, but that rally showed a lot of strength for gold. And so if this bottom that we're putting in, hopefully bottom, if this bottoms above that last double bottom, I think we're ready to go higher with metals.
I hope it's now. I'm encouraged by the triple bounce off that 1760-ish mark that you talked about. And may this be the reversal, but there's absolutely zero cause for concern if we do end up coming lower, as Miles pointed out. These are value opportunities. This is an absolute entry point as you bounce off a support level like this, and then you put the rest in as you see other opportunities or value increase as we come down to other levels of support as laid out in the chart.
Yes, and I think you're seeing confirmation both in the silver and the palladium as other precious industrial metals. I mean, you're putting in higher highs, you're putting in higher lows, especially in silver. Silver, the first big range was 30 down to 22. Then it was 30 down to 24, and now we're sitting at around 26. So silver could come down to maybe 25 this time before it turns around. And I think the timing of silver pushing down to 25 could coincide with, say, gold coming down to like 1730, and then you see a very sharp reversal back up the other direction. So pricing-wise, I can tell you as we're moving on with our charts here, something pretty fascinating happened this week, a little vindication, I guess, in the precious metals market that coincides with what we've been talking about as a company and the general reasons to own gold, and it's going to start making my job very, very difficult as a chart person going forward. And that's one thing we've always looked at is how the markets, how the charts, and how the commodities play off of each other going forward compared to inflation. That's sort of been the purpose of this show, is how do these prices relate to the inflation of paper currency? Well, the problem is we can't really look at physical gold that way anymore as of this week, because as of this week, the IMF has officially reclassified in the Basel III gold as being a Tier 1 asset. Physical gold, not paper gold, not spot price, not contracts, not mining companies. Physical gold is now considered equally as safe as any of the world's major currencies. It is an asset that does not really have the potential to go to zero.
Yeah, we were talking to David McIlvaney prior to the show, and he brought that up too and stated it because the Bank of International Settlements now views gold as one of the most riskless reserve assets on the planet. It absolutely lends credence to it because all you ever hear about is how much Wall Street looks upon it as being a worthless asset. And it went from Tier 3 to Tier 1. So very, very strong. A lot of listeners, a lot of our clients are asking us, what is the Basel III fallout? Now, Basel III officially kicked in this past Monday, right? So now the concern is, hey, are we going to see gold whipsaw here as a result of that? And the jury's out. The debate is on. Basically, they've got to step up with more reserve assets to back up any paper-based gold, unallocated ounces, something that's not considered allocated physical gold. And so the concern is, well, they're either going to dump their gold positions or they're going to step up and buy more physical. And the debate right now is centering around up, down, or unchanged. Sounds like unchanged is really winning. I don't see a whole lot of action. Nothing's really happened since Monday. We've been flat for the most part. And it'll be really fascinating to see if Basel III has an impact. And remember, that has only to do with the European banks. That's not a global issue, even though that opinion came from the Bank of International Settlements, the central bank to the central banks.
Well, and market and spot price have been relatively flat, but are we seeing flat pricing in the actual physical market? And see, this is the point I'm getting at, is this is something that we've all witnessed over the last year, especially with the increased buying in things like silver. I mean, for Pete's sake, even 100-ounce silver bars are at ridiculous rare coin premium at this point over the last year. So I think there are two enormous things that come out of this announcement. A, the thing that we've been preaching for 50 years as a company against people who have said for years it isn't true, just got shown true by the people that said it wasn't true. That gold is, without a doubt, the safest investment on the planet, period. And B, there is a massive disconnect coming between physical precious metals and paper precious metals.
That's right. We're already seeing it in silver when there was a run on silver. And those premiums on physical silver have kept deliverable silver above $30 an ounce.
Well above.
Well above. So we've already experienced this in the silver market. I think it's coming in the gold market, and it'll continue in the silver market, where if you want the real stuff, the actual metal, it's a different market. And the spot market is going to do its thing, while the actual deliverable metals are going to be harder to find.
Robert, that's really a good point. So let's price that in. All right, this week, the gold to silver ratio, if you just look at the futures market spot price, is relatively unchanged. We've gone from 67 to 68 and back down. Today, we're literally at 67.5. But with the premiums in the silver market setting their own market, the physical product in silver setting its own market, if you compared a 1-ounce gold bar to a 100-ounce silver bar, right now, the real cost of acquiring those two products drives the ratio down to, what was it that you said when we were talking?
61.
61. That's a 7-point difference in the ratio down, meaning it's building pressure. You're getting closer to moving out of silver into gold.
Because the physical silver has a premium to it above the spot price.
That's right. And we
right.
don't control that as a brokerage firm, as a dealer. That's just the real market. That's the wholesale exchange. Now, if we compare that to a 1-ounce gold American Eagle to a 1-ounce silver American Eagle, that ratio plummets all the way down to 51. That is a huge difference. That silver American Eagle is the benchmark 1-ounce silver product in the market, and it's telling you that either it's become overvalued or silver in predictive fashion is predicting that that gold-silver ratio on the wholesale spot market price is likely going to follow suit, and we'll be seeing that in the spot price soon.
And for those of you that are physical metals investors, obviously the difference between a spot price ratio of 67 and an actual real intrinsic value ratio of physical product all the way down at 51, that's an enormous difference. Over the course of a 10, 20, 30-year portfolio where you're looking at ratio trading back and forth to increase your positions, that's happening a lot faster, giving you a lot more opportunity to increase your ounces over time, which is our number one goal. You know, our number one goal is about ounce weight, not dollar price, because if you're increasing your ounce weight, the dollar price takes care of itself.
That's right.
You know, dollar price becomes irrelevant.
Over time.
Who cares what the dollar price of gold is if you turned 100 ounces into 200 ounces? It's irrelevant.
And the key takeaway there, too, is you're talking about currency devaluation and a weakening dollar. Gold is, not just because it was defined as a tier 1 asset, gold is the best currency. It's the number one currency in the world. It is the true world reserve currency. It's the asset preservation currency.
Right, and gold has always been a tier 1 asset.
Yeah.
It's just finally stated by somebody with a little bit more clout than I have, just barely. I think that the International Bank might be a little more popular than me by a few 100 million people. But with that said, we've always known, everybody's always known the position that gold holds in a portfolio. Its primary purpose is to preserve and protect because it's one of the very few things on this planet, other than the planet itself, that can't go to zero. And the reason it can't is because it comes out of the dirt, right? The only thing that can't go to zero is dirt and the stuff that comes out of dirt, and everything else is just make-believe. So we've always known gold was a tier 1 asset, which is why we don't care what the dollar price is. We care what the relative price of one tier 1 asset compared to another tier 1 asset, a real commodity tier 1 asset is. And we're starting to see that disconnect that is going to become paramount in your precious metals portfolio going forward, because more and more people are going to be taking advantage of having an alternative, guaranteed, safe investment other than US dollars and euros.
Yeah, and that relative value you're talking about there with the ratios, that is what we do. We do a lot of ratio trading in IRAs. It's a great vehicle for it because you don't have the capital gains when you sell outside the IRA. So inside of an IRA, if you have an IRA, you can do a partial rollover. You want a little bit of exposure into metals? All right, we'll take part of your IRA, roll it over into metals IRA, and let us ratio trade it for you. It's a perfect way to get an inflation hedge. And I think as we go forward here, I think you're going to get a lot of growth out of the metals market.
Yeah, it's not intended to be a performance asset, but you saw that last year. Gold was up 24%, silver was up 47%. That's from the start of the year to the end of the year. And why would you have your IRA sitting in cash? I talk to more and more people that have just gotten out of the equities and into a money market or cash position. Well, guess what? The way that you measure inflation, we talked about this last week, the way you measured inflation in the 80s, where you take into account food and fuel and housing, that's actually 13%. So by sitting in your cash position, you've lost 13%. That's what you're on track year over year in the last rolling 12 months. That's devastating to your savings. That's devastating to your retirement. So what if gold's down 6%? It's half of what inflation has done to your cash position. So that's why, again, gold is the true money metal. And even though we like the compounding ounce, we care about what the number is in terms of the ounces you hold. The rest of society, unfortunately, is subject to the pain that inflation brings. And what are we talking about? We're talking about the highest fuel prices in 7 years. They're up 57% for us locally. You're talking about housing. So housing just went up an unprecedented 14.6%. That's the highest housing inflation measure in the whole series history, dating back more than 30 years.
Does that have anything to do with Wall Street buying houses in big batches?
Yeah,
I mean,
absolutely.
It's just money flowing and going to hurt the small guy.
Because what are they doing? They're getting out of the dollar and they're getting into real assets. That's all we're saying to do, right? This is the most easily acquired real asset.
Yeah, just wait until big money comes over to the physical metals market because they're coming.
They are. And you know how many trillions of dollars have been created that weren't even in the system back in 2011 when gold topped, when silver hit $50 an ounce. We're going to blow through it so easily because there is so much more money in the system. So much has been created and so much has been made. Another inflation measure, June rent has had its biggest jump on record as well, up 9.2% so far in 2021. The pain is real. People are starting to feel it. And I'm telling you, it's going to create a political sensitivity that turns into a geopolitical strain because right now, the people that feel it even more than we do are the developing nations getting hit the absolute hardest.
Well, and you also said local gas prices up 56%, and you're going to get a phone call tomorrow from one of your California clients, both laughing and crying at the same time. Because my buddy who's continually sending me photographs from his local Exxon station, I think the last price was $6.25, if I'm not mistaken. So he's currently in the process of moving to Florida and can't get out of there fast enough.
That does us this week for Golden Roll Radio. You can follow us on Twitter, ICA Gold. Like us on Facebook, McIlvaney Financial. Click the subscribe button below. Or you can always call us at 800-525-9556.
You can also find more info on our website at mcilvaney.com. Thanks for listening and have a great week.